Good afternoon. Thank you for joining our webcast on secondary and tertiary multifamily and commercial real estate markets. I'm Keith Fung and I'll be your moderator today. Commercial real estate investors are getting a jump on the competition by heading to secondary and tertiary markets that are on the verge of turning around. You don't want to be too late in joining these markets. Which second and third tier cities today offer the best prospects for real estate investments? How do we find opportunities and underwrite and negotiate deals in these markets? We have a panel of experts today who will be answering or providing tips for these and other questions. We're honored to have on our panel developer Albert Berriz, investment advisors Gary Ralston and John Sebree, and financier Ernie Katai. Our audience is in listen-only mode. You'll be seeing a window where you can type in questions. After the presentations, we will pass your questions to our experts. Our first speaker will be Gary Ralston. Mr. Ralston will focus his remarks on commercial properties, retail, industrial, office, hotels in secondary and tertiary markets, and he will be presenting us with a number of key investment and market data. Mr. Ralston is managing partner at Coldwell Banker Commercial Saunders, Ralston, Dantzler, Realty, a leading commercial services provider in Central Florida. Termed a retail wizard by Commercial Real Estate Investment Magazine, he is a recognized subject matter expert on retail and commercial properties. His consulting assignments have included handling Florida REO properties for one of the nation's largest special services of small commercial loans. He has been president and member of the board of directors of Commercial Net Lease Realty, Inc. Among his many positions, he is a past president of the Florida CCIM chapter and an instructor for the ICSC, University of Shopping Centers at Wharton. He is also a member of the Regional Economic Information Network for the Federal Reserve Bank of Atlanta. I'm going to pass the presentation to Gary. Gary, the floor is yours.
Thank you, Keith. It's a pleasure to be here today. You know, just as it seems that we might be adjusting to the new normal of a slow-growing economy, the economy slowed even more. All of the key macroeconomic indicators dropped in the second quarter of 2012. GDP, job growth, consumer confidence, manufacturing growth, retail sales, and others. It became clear to those of us in the business that we were pretty close to the edge. In fact, several major states continue to face huge budget shortfalls, including Illinois, Massachusetts, and California. And an increasing number of counties and cities are struggling with severe debt shortfalls. The balance of the year is not expected to be much better, with its own set of looming issues: the upcoming November elections, the fiscal cliff of automatic higher taxes and reduced government spending, the debt crisis spreading throughout Europe, and slow growth across the globe. In fact, the uncertainty we've been dealing with for the past few years is intensifying, and investors are refocusing on safe investments. That's evidenced by the lowest yields on 10-year U.S. Treasuries in history. At this point in the commercial cycle, commercial real estate also offers a safe haven. The increasingly lower returns in the major markets is motivating many investors to look for opportunities in some of the secondary markets. The real question is, what is that opportunity? How to identify it and capitalize on it? Data from Moody's and Real Capital Analytics disaggregating major and non-major markets going back to 2000, in fact benchmarking this with 2000 as the entry point, shows that during the upturn, which some people call the bubble in real estate in general, major markets outperformed. They declined, as did secondary markets. Secondary markets, however, declined more precipitously. And in fact, by the bottom, prices had returned, in effect, to what they were 10 years earlier. And we've kind of mirrored that activity level for the most part. As you will notice today, there is a meaningful gap between the indexed pricing in major markets and secondary markets. And that, of course, leads to the question, why and how does one capitalize on that opportunity. The major markets have been leading secondary markets in the recovery across all sector and property types. The performance of the sectors in the secondary markets frankly track exactly what's happened with property types in the major markets. Let's look for a moment at the sub-indices, peak to trough. The index, of course, dropped from October 2007 to March 2010 by 40%. That is a compelling situation, probably doesn't surprise many of you that have been active in the business. Most property owners and many participants do not fully realize and comprehend what happened, why that occurred, and of course where things are going. There has been a meaningful recovery, but the bottom line is on an aggregate basis in secondary markets today across the country, commercial prices are still down about 30% from the peak in 2007. This represents a special opportunity for those who know how to navigate through the properties and find individual pearls, as we call them. Examining the sectors, of course, the decline and recovery is pretty much broad-based and consistent. Retail probably was a little more severe, backed by CDB office and secondary markets. And retail may, in many minds, have the best opportunity for recovery. This decline in value, obviously, is directly attributable to the capital stack applied to properties in these markets. And so if we compare a bit what happened with major markets, non-major markets, and the amount of distress activities, you can see that there is a meaningful gap in the financial performance, the distressed assets, the troubled assets in secondary markets. This remains a major opportunity. And we'll talk a little bit about how to focus on that on an individual basis. As further proof of this gap between the performance of major markets and secondary markets is to reflect upon the indices that are generated in the market, concentrating on those property types. The NACREIF returns, the National Council of Real Estate Investment Fiduciaries, is primarily focused on larger markets with a big concentration in what they call the 24-hour cities. The Real Estate Research Corporation returns are primarily indexed to secondary markets. And as you can see over the last year, there is a meaningful gap or differential between these, indicating that the major markets have already benefited from a degree of bounce and opportunity. Particularly when we look at the 10-year returns, you can see that the incremental difference is much smaller. This would lead a statistician to conclude that secondary markets have a unique catch-up opportunity and will follow in the draft of the major markets over the next few years. Looking a little closer at small opportunities, smaller data sets, we've kind of disaggregated to the regions of the country a variety of rates of return that might apply. It is interesting to see the wide variation across the property types which permeates the entire country. This increasingly evidences the need for the appropriate guidance to discern what is the opportunity. There is a closer set of data in major markets. So in the secondary markets, this wide variation, as you can see, going in cap rates are ranging from the 6.5–7% range up to 13%, as the case may be. So it means that some discernment is required to ascertain what the opportunities really are. And that is compounded by the predominance in the market of what we identified as troubled assets. Let's focus for a moment on maybe the best opportunities and how to figure out what to do and navigate effectively through. We like to think of real estate, no matter what size the market is, as being, in the simplest terms, just space for people. Think about it. Real estate is space for people to live in, work in, shop in, and store things in. And so there is a direct correlation between population and population growth and the demand side of real estate. As you're probably aware, annual population growth nationwide is just slightly less than 1%. So the goal is to focus on metropolitan statistical areas and counties that are growing at 1.5% or more. The key of those, obviously, is Florida, Texas, and Nevada. And don't forget about employment growth. Jobs and population are highly correlated. The Bureau of Labor Statistics has forecast the sectors where there's going to be growth and would lead us to believe that certain property types, those that have medical uses associated with them, those that have education uses associated with them, and distribution within certain key linkage areas, particularly taking into account on the eastern half of the United States the impact of the widening of the Panama Canal and how there may be a shift to some of the port-driven cities. Ultimately, though, real estate, especially in secondary markets, is extremely granular. You know, we often talk about it as being a property-by-property proposition. It's a battle out there, and it's fought with short swords, not long-range laser rifles. So it's important to get right down to the property level. One item which is helpful is to benchmark the trade or service area of the property that you're analyzing using the county, the metropolitan statistical area, the state, and the United States to identify opportunities within the geography. My final comment is because of the opportunities in troubled assets and the difficulty in analyzing those on an individual basis, it's important to work with the best local professional. Let me give you 3 simple questions to help you ascertain who the best local professional is. And of course, if you're in the business, make sure you can answer these questions when investors come to you with the questions. Again, going back to that basic of real estate being space for people and population is the demand driver, you need to know very quickly off the top of your head the population for the geography in which you're working. That formal geography could be the county or it could be the metropolitan statistical area. And you need to know the employment information, the current employment numbers, preferably both using the household survey and the establishment survey. And finally, you need to know the supply on a granular level. We suggest data mining the property appraiser's information to make sure that you have an accurate list of available property types. Thank you, Keith.
Great, Gary. Thanks so much for a wonderful presentation and great analysis, and thanks for your tips. All right, our next speaker, going on to our next speaker, Gary covered the commercial real estate sector in his presentation. Our next speaker will focus his remarks on the multifamily sector in particular. John Sebree is Vice President, National Director of the National Housing Group of the Investment Advisory Services firm of Marcus & Millichap Real Estate Investment Services. Mr. Sebree will also be providing us with market and investment data using the research resources of Marcus & Millichap. His extensive background as a major multifamily specialist spans more than 20 years, 17 of which were as Marcus & Millichap agent. Most recently, Mr. Sebree was a managing director for HFF, where he brokered institutional multifamily properties throughout the Midwest. He has earned numerous plaque awards, 8 National Achievement Award qualifications, and top 20 Chairman's Club designations. We're pleased to have him on our panel, and Mr. Sebree will be focusing on the multifamily sector in particular. John, the floor is yours.
Thank you very much, Keith. And let me get this set up. My focus is going to be, as Keith said, on secondary, tertiary markets for the multifamily. What I want to do is start with a macro perspective and then drill down on specific markets while addressing vacancy rates, employment growth, and cap rates. Reviewing the primary regions of the country, the Northeast and Pacific Coast have the lowest vacancy rates at about 3.3 to 3.5%, with the Southwest reporting the highest vacancy rate in the area of 6.4%, as well as the most positive improvement during the trailing 12 months with a 160 basis point decrease. The encouraging fact is that all these regions are reporting relatively strong occupancy rates, and you can see they are all reporting a more positive or a better occupancy rate today than where they were 12 months ago. We follow employment trends very closely. Gary touched on this, and I think people in real estate are always following employment trends very closely, just because that affects every little thing that we do. The interesting fact shown on this slide is the change in employment in the primary, secondary, and tertiary markets have historically tracked in lockstep during economic downturns. Notice, though, that tertiary markets tend to be more stable over time, while the secondary markets appear to report the greatest volatility with the highest and lowest numbers. So if you look at the blue line, which is the secondary markets, looking at 84 and 95, those are kind of the highest numbers at the peak, and the secondary markets are jumping up there at the top, but then in 03 and 2011, they end up being towards the lowest. National Employment Metro Ranking. Top of this list is very heavily weighted towards the primary markets. This chart shows greatest change in the primary markets, with percentage changes highest in San Francisco Bay Area at 4.4% and 3.5%, and then also at Houston at 3.2%. Highest percentage change of employment in secondary markets are reported in Denver, Austin, and Phoenix, all at about 3%. And the highest percentage change of employment in tertiary markets are coming in with Knoxville, Coldwell, and Oklahoma City, just under 3%. To keep things in perspective, the highest absolute change in the number of jobs is led by Houston with 83,000 jobs. Dallas, Fort Worth, and Los Angeles are at about 60,000 jobs. The highest secondary market is Denver at just over 36,000 jobs, and Austin at 23,000 jobs. So there's quite a bit of a difference between those. 11 of the 15 listed here are showing up in the Southwest and the West Coast. This is National Employment Metro Ranking by percentage change. So the lowest percentage change in new jobs is dominated by the tertiary markets, with several reporting job loss during the last 12 months. Keep in mind a net gain or a net loss of 1,500 or 1,000 jobs is generally considered to be relatively unchanged. Only two of the secondary markets, or only two of the bottom 15, are actually secondary markets, with Baltimore and St. Louis. All the others are tertiary. This slide shows vacancy rate changes by primary, secondary, and tertiary markets. Notice how close this graph ties with the earlier employment slide. Interestingly, going back to 2002, the secondary market shows the most extreme improvements and the highest change, then dropping to the lowest in 05 and back to the highest in 09, and again the lowest in 11. Apartment vacancy rate by market type. So when we're looking at actual vacancy, the primary markets consistently report the lowest levels. Note spreads in 05 and 07 between primary versus secondary and tertiary markets, and then again in 2010. Primary markets tend to move first, and then secondary markets start to follow. Notice how the gap is diminishing in 2011 and 2012, with secondary markets showing the greatest movement. So really what's happening in an 11 and 12 is the gap is remaining somewhat consistent between primary and tertiary, but the secondary market is sliding from that tertiary line a little bit closer to the primary line. National apartment metro ranking by vacancy. So these are the markets with the lowest vacancy. And if I bounce through these pretty quickly, if you look at the primary markets with the lowest vacancy are going to be New York at 2.2%, and then San Jose, San Francisco, and Oakland. That's really all just going to be the same greater metro area around San Francisco Bay, and those are going to be at roughly 2.5 to 3.3%. If you look at secondary markets, Portland at 2.2%, Minneapolis at 2.4%, and San Diego at 2.9%, and tertiary market with the lowest vacancy is Salt Lake at 4%. Metros with the highest vacancy in the primary markets, Houston at 7.6%, Atlanta at 7.2%, and the secondary markets, Las Vegas at 7%, Phoenix at 6.4%, tertiary markets, Jacksonville at 8.4%, and San Antonio at 6.5%. To keep things in perspective, the worst occupancy rate on here is Jacksonville at 8.4%. It was not too many years ago, that we were looking at secondary and tertiary markets, select markets around the country that were struggling with a 12, 14, 15% vacancy factor. So even though we're pointing out some of these markets that are struggling from a 20,000 foot perspective, we're doing much better than we have been in the past, obviously. National apartment metro ranking by vacancy change. So this is the most positive movement on occupancy. So the most positive movement at the top of this ends up being Houston with 220 basis point increase. Houston was also on the previous page with the highest gain. I said that wrong. Houston was on the previous page with the on 2 pages ago with one of the higher vacancies. So they have a higher vacancy, but they've also shown some of the greatest change. Atlanta at 160 basis point gain. Secondary markets, Phoenix and Charlotte, 190 and 180, and then tertiary markets, Columbus and Salt Lake at 190 and 160. The most negative movement on occupancy, primary market. This is very interesting as well. Primary markets, New York and San Francisco. Those are being listed as having negative movement. It's less than a half a percentage point, so it's 50 to 70 basis points. And those markets are already at 2.2 to 3% vacancy. So I think it's just that they're right up there at the top and they really don't have anywhere to go. Denver didn't show any movement. Again, they're at less than 5% vacancy. Minneapolis, about 50 basis points. They're at less than 2.5%. And then Louisville and Milwaukee at 20 basis points and 60 basis points. Apartment effective rents by market type. So if you look at the red and the blue line, look at the primary and secondary markets, and this shows what kind of year-over-year rent growth that they had. And you can see the long trend going from 02 up through 08, and then how it drops back down in 010 and how that's grown back up. I almost took this slide out because I cannot fully explain what is happening with the tertiary markets. And it was a long conversation with myself and our research department. But I think there were probably a couple of things that were coming into play there. You had a compression of the cap rate spread between the primary and the tertiary markets in 06 and 07, and that drove many of the investors into the outlying markets. And then simultaneously, you had a spigot of new single-family home construction that was kind of turned off in 07, which increased the competitive advantage of a lot of these owners in tertiary markets. Another factor that could have come into play on it is if you're in a secondary tertiary market of say 800,000 or 900,000 people, and you end up with 3 or 4 brand new construction apartment complexes at 250 to 300 units each, all coming on the market at relatively the same time, that could move the needle on what your average rents are and how much rent growth you're having in that marketplace. Repricing of risk by quality reflected in apartment cap rate trends by market. Cap rate trends among types of markets mirror the institutional and major private investors' appetite for the best-of-breed properties throughout the recovery, which has created a sizable cap rate spread between primary markets, secondary markets, and tertiary markets. We are now actively seeing capital from both private and institutional move more into secondary markets and into smaller submarkets in search of higher yields. Not as much into true tertiary markets yet, but I think that will come. Notice in 2007, the cap rates between primary and tertiary markets, that spread was only about 60 basis points. Today, that spread is about 300 basis points. If I'm going to look forward over the next 24 months, I think that spread between the, basically between the, the red, the green, and the blue line starts to come down. Basically, what I think happens is that green and red come down into the blue, or get down much closer to it over the next 24 months as more investors start getting away from primary markets and chasing higher yields. The previous slide was by market. This slide is by class. There's a lot of similarities, but we do look at both of those. And this shows the spread between Class A and then also Class B and C assets, which is fairly wide, unlike the 05 and 06 market peak when there was barely a spread. And Class B and C cap rates have not come down nearly as fast as the Class A just due to the risk factors involved. But we expect that to start to narrow moving forward. The last slide I've got is one of the very frequent questions we get from investors around the country is it too late to invest in apartments? And our cap rate getting too low. One way to measure the risk-reward for the overall apartment market is the gap between interest rates and cap rates. As you can see from the graph, when the gap has been large historically, those periods prove to be a good time to buy for apartments. For example, 92, 98, 2002. By this measure, today is an incredibly good time to purchase. And again, what we're showing here is you've got a 430 basis point spread between what our cap rates are today and what our 10-year Treasury is. That's what I've got for my slides. One of the questions I did want to mention is during a discussion with Keith, she was asking me, when people are working with the brokerage community, if you had advice for investors who wanted to work with the brokerage community, what are a couple of What are a couple of things that the brokers look for in an investor? I think the most important thing is working with investors who have a game plan, who have a concise view of what they're looking for. For example, I think if you walked in and met with a broker who was in the state of Texas and you said, "Yeah, I'm looking for apartments in the state of Texas," that's awful broad. I mean, it's going to go a long way. There are way too many factors that are going to come into that. And I think a lot of brokers, and I'm not just talking about Marcus Millichap, I think any professional in this industry would have a little bit of a difficult time trying to figure out, where you were going. I think that looking into it more, digging into, Gary was talking about digging into some of the numbers and finding out what your employment numbers are going to be, deciding exactly what kind of product type you're going to be looking for. I think at that point, brokers are going to be able to help you out tremendously and really help you zero in on the best opportunity. And that's all I have. Thank you.
Thank you so much, John, for your advice and the wonderful presentations of all those secondary and tertiary markets data. Now we will hear from a developer. What would a seasoned developer say are commonly overlooked secondary and tertiary markets, and what are his words of advice regarding how to find and invest in real estate opportunities in these markets? We are pleased to have as our third speaker Berriz, CEO, board member, and shareholder of McKinley. McKinley is a 43-year-old real estate investment and management company with a portfolio valued at $2.89 billion in office, retail, and multifamily housing. The company is a leader in all aspects of investment real estate, operating on behalf of both its own portfolio and select clients. Mr. Berriz has extensive experience in the acquisition, financing, management, and redevelopment of real estate assets. He has been responsible for acquiring and managing assets in excess of $4 billion during his career. He has received many honors and awards, including Ernst & Young Entrepreneur of the Year, 2007 Ann Arbor New Citizen of the Year, and Crane's Detroit Business American Dreamer Award. We're very pleased to welcome Mr. Berriz. Albert, the floor is yours.
Thank you, Keith. I want to thank Gary and Jonathan. They did a terrific job. My presentation will be far less analytical from a numbers perspective, and it will be more to do with actual deal flow that we've got in-house today and things that we're seeing and things that we're doing. I want to leave the audience with 4 ideas as takeaways. One is I want to talk about commonly overlooked markets. I'm going to talk about markets with the most opportunity. I'm going to talk about asset class opportunities. And finally, I'm going to share what we call strategies to win. And, and I think we're doing a significant amount of both good deals and a good volume of deals. And so to the extent that we can, we'll share with the audience those things that are allowing us to be successful. Let me start, if I could, with commonly overlooked secondary and tertiary markets. And by background, our portfolio is 35,000 units in 25 states and 17 million square feet of what's mostly retail and some office. Everything we do is distressed, and so we're either buying distressed real estate going in, or we are also a major workout operator of distressed institutional real estate, and that is for pension funds, insurance companies, special servicers, and commercial banks. So from our perspective, we've got 3 major markets. The Midwest market is where we're from, and it's where we started our business. So anywhere between Michigan and Minnesota and Pittsburgh down to Kentucky, that's our first core market. Our second core market is the I-85 corridor, which is Maryland down to Florida, and then the western markets, which are Texas, Arizona, and Nevada. I just highlighted what I call the I-85 corridor, the I-85 to Florida corridor, and pointed out places that people commonly overlook. What we have right now in our shop is 20 markets that we have on the wall. These are markets, they're all mostly tertiary and some secondary, and these are all markets that we're actively looking for deals. What we do, in fact, is in every single one of these markets, we're either owning a significant amount of real estate or we're operating a significant amount of real estate. So we're both cataloging our rent rolls and or the things that we're hoping to buy that may be just across the street from the buildings we already own. So strategically, we're very surgical. We're only looking in those markets. It's a very defined 20 markets, and it's those 20 markets we know quite well. So that's a major advantage for us. And I'll give you 3 examples, and I think Gary did a great job, but so did John, on the issue of jobs and growth. These are 3 markets that if you look at the inside of these markets, there's terrific job growth. Cary, North Carolina, if you look at companies like SAS, the Research Triangle Park, there's real jobs. They're great paying jobs. Spartanburg, it's the new manufacturing South. What we lost in Michigan, they've gained in South Carolina. They've got BMW, they've got Boeing. And you've got a market like Gainesville, which most people think is a university town, but it's a great medical town. The Shands Medical Center is a great employer, and there's high-paying jobs. The reality is that most people don't travel to these markets. My rule of thumb is people in New York and New York City, if it takes them 2 or 3 flights to get to a market, that's the market that I want to be in. And so obviously those are markets that are hard to get to. Even from Ann Arbor, it's not easy to get to a place like Spartanburg, South Carolina. For us, we have people on the ground that have been living there for many years, so it's easier for us. But having said that, if you're out and more of a shotgun approach, these are markets you're going to commonly overlook. There's terrific opportunities. There's terrific job growth. And for us, there's great financial opportunities from the perspective that in these markets, for example, we're actively underwriting and looking at deals that are at 8 to 10 cap rates. Our investment criteria is a little bit different than most. We don't look at rates of return. What we do is we go in and buy it somewhere between 8 and 10. We look at rent rolls where we can change the rent $200 per month going in. And we look to recover all of our capital in 3 years or less. I think John said it very well. I've never seen a better time in my 35 years, and it's quite easy because if I can go in and buy somewhere between 8 and 10, and I turn around and finance with Ernie at sub 3% on 35-year financing with HUD, or even sub 3% financing or 4% financing with 10-year financing with Freddie Mac, the spread between what we're buying going in at 8% to 10%, our ability to move rents, maybe a couple $100 a month, and then turn around and finance long term at unheard of numbers. It's a very rare opportunity, and you would think everybody would be there, and they're not. So I think I urge the audience to think about places. For us, all of these markets have great employment drivers. They have employers that probably will never go away: major universities, major research functions, major manufacturing. And while I can't cover the entire country, I just wanted to cover the I-85 corridor and offer 3 different ideas for you to think about. My next slide is about most opportunity. And again, when you look at our business, about a significant part of it is institutional workout business. So we're doing a lot of 2013 through 2015 surveillance. And, we're seeing what everybody else is seeing is there are 3 markets that above all other markets have the most significant amount of distressed debt and distressed deal flow out there. They're not surprising to anybody. However, I'm always surprised when we're either selling assets on behalf of institutions or trying to acquire assets. The number of people in these markets that you'd think would be out there, chasing individual deals or large portfolios, still is significantly less than what you see in the primary markets. So, and again, you have to be very judicious. We never look at any of these markets holistically. We are neighborhood buyers. So, when we buy in Orlando, Florida, we love Winter Park, Florida. We love Southwest Orlando. We don't like Seminole County. So we're very surgical about what we don't like and what we do like. So when we say Houston, Texas, and that's a pretty broad geography, so you've got to be very understanding of those markets and understand that even though Houston's a good place to buy, there's a lot of bad deals out there and there's a lot of good deals out there. But if you look at total deal flow, particularly in multifamily and retail, this is where you're going to find it over the next couple of years. And I think that it's not a surprise because there's a significant growth in transfers to special servicing and other lenders that are dealing with a significant amount of bad debt in these markets. My next slide is asset class opportunities, and I think I've covered it already, but just to repeat, I see most on the multifamily and C-class multifamily. It's what we like to do. It's what we prefer to do. And if our job, if we're doing it right, we're turning C's into B minuses. And, that's mostly what's out there. You've got to be careful. There's a lot of C, poorly located multifamily that probably can't be turned around. It may be a physical plant problem. We're seeing a lot of markets. I talked about Atlanta earlier. I mean, if you go into Stone Mountain as a submarket in Atlanta and you think you can change rents radically over the next 10 years, you may want to revisit your pro forma. So you've got to really understand those markets well. So no, not all markets, not all submarkets are created alike. But if you wanted to look at an opportunity in terms of asset class, there's no question that C multifamily is there. And the other one, which is very exciting for us because nobody can put their head around it, because unlike multifamily, where there's obviously a very clear exit strategy in terms of end financing, retail is very blurry right now. And we like that because it creates a lot of opportunity because people can't figure it out. So I think that, again, it's interesting to see the kind of deals that we're seeing and at prices that we're actually pretty blown away that we can buy them at. So the 2 places that I see the most opportunity are C multifamily and retail. Let me cover my last slide, which is what I'll call strategies to win. Our philosophical approach to this is we want to bring primary market strengths, both in capital and expertise, into secondary and tertiary market environments. As an old-fashioned property manager, we like to compete in markets that people aren't good at operating property. We also like to compete in markets where people have limited capital. So if we can get primary market strengths and take them into secondary and tertiary markets, it creates a significant advantage. I will tell you, compared to, let's say 5 and 10 years ago, we probably looked at 20 deals to do one. We're probably looking at 100 deals to do one. And people say, well, that sounds not right. It's true. It really is. I mean, we're looking at a lot of things that we put up on the wall, and we look at it, and we look at it, and there's a lot of deals that we make offers on that we're the 3rd or the 4th buyer, and they don't get to us for a while until they work through the first 3 offers. So there's a lot of deals that we look at before we do one. And we've been closing a lot of deals. Ernie finances our deals. You're going to hear from Ernie in a few minutes. We've kept them quite busy this year, but it's because we've been looking at a lot of deals. And I just urge you to think about the way to produce deals is by really working them and then saying no when you don't want and saying yes when you do. Transaction history, I think John talked about it a lot when you're reaching out to brokers. We have a reputation of closing every deal that we put under contract, and we don't retrade people. We have a very stellar track record in that respect, and we're very proud of that. So when we go to people like John, or we go to lenders and we make an offer, they know our ability to close, and so I think that it's not a surprise. You're going to create a reputation as a buyer, and in this market, people like John can choose, and people that he represents can choose. So transaction history and reputation is a key strategy to win, in my opinion, in this environment. The other one is to have a key differentiator. For us, it's cash to close. We put properties under contract. We're putting up a significant amount of down in terms of an earnest money deposit, and we're able to close in 5 to 30 days. So we're an all-cash buyer, closing immediately for cash, putting a significant amount of earnest money deposit up front while we're looking at deals. And that's going to be something that when you're competing with others, if you can show that strength, it's a key differentiator. And you've already heard it from Gary and John. You'll hear it from Ernie in a minute. Gary and John and Ernie are the guys that produce deals. So having great relationships with them are the ways that you're going to find deals. And we make it a living to have long-term, high-quality relationships with people like them, because quite frankly, they are the ones that are bringing us deals. We are also finding a lot of deals directly through lenders because of what we do. But having said that, the notion that you can always, everybody's wanting to find this magical secret of off-market deal. Well, there's a million people looking for it. So it's not like they're all out there. So I strongly urge everybody to have great relationships with your brokers, your lenders and servicers, and they're going to produce deals. And I think John said it as well earlier. We're very product and market focused. So if you're going to be in those 20 markets competing with us and ready to buy against us, we've done our due diligence before we've made an offer. We have those markets on the wall. We know which buildings we want to buy. We know what the rent could be after we buy them. And to the extent you can be that laser focused and not just say I want to buy apartments, but I want to buy apartments in this market and in this submarket of this market, you'll be far more successful. I was asked to talk a little bit about negotiating and underwriting, and I think I've covered them in my strategies to win. And again, I think in terms of the underwriting and the negotiating, if you are ready in advance of making offers with your numbers, so you know what you've got to do in terms of movement and ready to close, it's going to make a key differentiator. I mean, deals are trading much quicker than they have in the past, particularly the good ones. So it's having significant market knowledge and really making sure that you've underwritten the deals in advance of going in is a key strategy to win. That's it for me, Keith. I hope that helps.
Great, Albert. Thank you so much. Thank you for being so forthcoming, and thank you for sharing information with us. Really appreciate it. Going on to our fourth panelist. Our fourth panelist will speak from the lender's perspective. We're very pleased to introduce Ernie Katai, Senior Vice President at Berkadia, one of the nation's leading providers of capital for commercial real estate and a highly rated primary, master, and special servicer. Follow the money. Besides being of interest to developers who need capital, capital availability in the market may also be indicative of future property values. Mr. Katai will discuss secondary and tertiary markets that are gaining favorability with lenders. Mr. Katai is responsible for originating commercial real estate loans for the Berkadia Commercial Mortgage Detroit office and also serves as branch manager. Loan production under his management has been in excess of $5.1 billion. Mr. Katai has 27 years of industry experience. He's also a licensed real estate broker in Michigan and a member of the Urban Land Institute, ICSC, and Mortgage Bankers Association. He sits on the Nationwide Financial Correspondent Advisory Board. His numerous awards include Top Originator of GMAC Commercial Mortgage and Capmark, Manager of the Year, and GE Platinum Award. Ernie, the floor is yours.
Thank you so much, Keith, and I want to thank you, Albert. That was, you actually nailed it, and I appreciate the fact that you were willing to show us a little bit of the inside the McKinley war room of what you guys do to look at the respective markets. And, you know, it's interesting because the way McKinley attacks it, and I also like to thank Gary and John for the technical aspect of what we're really seeing with cap rates and everything out there. But, you know, it's not exactly a science, and I think Albert showed that in his presentation. And lenders kind of address it the same way. I'd love to say, guys, here's a formula. This is how you get your deals done in secondary and tertiary markets, but there is no formula. Everything is per the individual lender, and that's part of our job here is to sit and seek out these type of lenders. I started looking when I was making my notes for this presentation. I started looking at deals that we've done over the last handful of years in secondary and tertiary markets out of this office here in Detroit, and I got to admit I was somewhat pleasantly surprised because if you look at the map that's up on the screen, everything that's colored are states that we have either done and closed deals in secondary and tertiary markets, or we went as far as application and the seller did not either, you know, consummate the sale or the deal. They opted to go somewhere else. But again, these are markets, when you start looking at this map, there are some very small secondary and tertiary markets here. And it's also kind of interesting. We have the formal definition, and I think we saw in John's presentation, you know, a good definition of secondary and tertiary markets. But it's interesting when you start chatting with the lenders, they each define these markets differently. What's a tertiary market to one lender is a secondary market to another lender for whatever reason. And you know, it's interesting. You look at this map and you say, well, you guys are located in Detroit. You've got a lot of the country colored. Well, part of the issue is when you've been in Michigan and Detroit for the last 10 years, it's not been an easy job. And we really had to diversify, and we had to start really looking to expand our horizons outside of the Midwest and basically across the country. And we just had to get creative, and that's what kind of led us to secondary and tertiary markets and financing opportunities. But you know, based on where the economy has been over the last few years, the secondary and tertiary markets, I think Gary referred to, were effectively ignored, especially by the lending world. And in fact, if you look back as late as July 10th of this year, in an issue of the National Real Estate Investor, there's a quote in there that I'm going to read to you because it shows you how in real time we're really operating here. The quote was, "It is difficult to entice life companies and major banks to go into the secondary and tertiary markets. The focus is strictly on high-quality, core real estate and primary markets." This statement was made less than 90 days ago. So as we speak, the good news is even in that 90 days, we've seen an improvement in the markets, gaining strength. The momentum is still somewhat fickle, and the economy, as we all know on this line, remains inconsistent. The world continues to be unstable, both politically, economically. You know, Gary referenced the election coming up in November. There's a lot of there's a lot of unrest out there. So with that, you know, it's still a little bit of a wild card in how the lenders look at respective markets and really looking into the crystal ball, what they're going to do down the road through the upcoming year. One of the issues we deal with in lending is, unfortunately, with a lot of lenders, it's a herd mentality. A group of lenders start to go out, and then, you know, everybody kind of follows them. But we've been combating that for the years, and you know, we've been able to work our way around it. You know, one of the questions we have is, you know, what markets are favorable, and what do lenders like? In doing this and thinking about this, I pulled quite a few lenders, and typically what I did is I went to the lenders that we've done deals with or that we know quote deals in these secondary and tertiary markets to kind of see, you know, really where their sweet spot was. You know, Albert kind of nailed it with the Carolinas and Texas and Florida, but basically what there is with a lot of the lending community is there's what is called the smile of the United States, which starts up in Seattle and then drops down through the West Coast, down through California, Texas, Florida. I think those are both on Albert's hit list, up through the Carolinas, all the way up into the northeast, which is Boston, obviously, New York, and even a little north of Boston. This area, even from a secondary and tertiary market, is considered the more desirable area. Obviously, that leaves a big part of the country out of the loop if you go back to this map. You know, what about the people in the Midwest and the central U.S.? And really, it's interesting because in looking at that, the problem that is going on is this geographic smile, as we call it, is characterized by low cap rates, long amortizations, and low interest rates. And there's a whole group of lenders out there that are starting to say, look, this doesn't make a lot of sense for us. We're trying to find a differentiator. We want a little bit of return. We think the cap rates are too low in California, that type of thing. And they're starting to look for opportunities around the country. So it's interesting, even though that comment was made 90 days ago, there has been a change in the mentality of a lot of the lenders because they're finding that when they go to compete in some of these markets, they're basicly coming up empty, and they're not going to be able to provide the rates that are winning the deals and that type of thing. As everyone knows, that that this is part of what we started looking into here, because I always say we have in Detroit it's adapt or die kind of mentality. As obviously we're very heavily auto related and that type of thing. What I did is I polled a group of lenders, secondary and tertiary lenders. And it really comes down to fundamental economic issues, and I think Albert talked about the fact that you got to do your homework, and people like McKinley are in the market having done their homework, and they're ready to move very quickly, and that's really what makes them successful. I think Albert threw a number up there that they look at 100 deals really to find one. So it kind of boils down to hard work, but these factors include no single big employer. I heard that over and over, that going into towns where there's one big employer is just not something they're looking for. They want to see job and demographic growth in these markets. They look real hard when they're looking at the individual assets to lend on for remaining lease terms. They obviously are going to look at credit quality of the tenants. And really one of the things that kept coming up over and over is the financial strength and experience of the borrower. A lot of concern I heard from them is that there is a huge quantity of deals out there right now in the secondary and tertiary markets that are single-tenant properties, and a lot of borrowers are out there with scant or no real estate experience. And despite being credit properties on some of these, the lenders are really starting to shy away from the lack of experience and wherewithal. The one thing you got to expect in these smaller markets is you're absolutely going to have tighter parameters. You must keep that in mind when you're looking at acquisitions. You need to be talking to people on my side of the ledger to get continuously updated on how the markets are changing. What we're finding is a lot of desirability in college towns. I think, again, Albert tapped on that. Government hubs, research centers. To give you an example, markets that kept popping up and that are definitely secondary/tertiary markets. I kept hearing about Omaha. I kept hearing about St. Louis. I kept hearing that these are real cities with strong, diverse economies. That's the kind of thing they're looking at. They're looking, basically the lenders are out there looking, just like you, for quality assets that have a lower purchase price. And the competition's not going to be as stiff as what they have to face, in these major markets. And that's really what is becoming the attractiveness. That's why when I say we've seen improvement in 90 days, we absolutely have. The next question that comes up is level of capital available today in these markets. And some lenders we're seeing put cap rate floors in. We always hear about interest rate floors, but in secondary and tertiary markets, we do have to deal with that sometime. Not all, but for example, a number that popped up a couple of times was an 8% floor. They're not going to go into some of these small markets and look at a multifamily deal that's going to trade at a 6 cap. That's just not going to be what they're out there looking for. All things being equal, pricing in secondary and tertiary markets will be wide. There'll be some widening out of that depending on the property type. Recourse is sometimes required, and sometimes it's often required depending on how small the market is. With that said, we actually have one lender that will even go down further than a tertiary market into county seat towns for the right deal. So again, even if it's a small town, it's worth having a conversation with us on the mortgage banking side to at least see what we're seeing and what the nature of the market is. And looking at multifamily, this is as solid as a product type to finance in the tertiary markets and secondary markets as there is. I mean, the capital flow is strong. It's a direct result of the primary markets being so price competitive that lenders are to grab multifamily product are dropping down into secondary and tertiary markets. The playing field is significant. The agencies, being Freddie, Fannie, HUD, still play in that arena. Small life companies love it, and the conduit world has kind of stepped up and jumped into this because they can't capture the multifamily product in the primary market. So it's pretty flush with cash on the multifamily side. We saw the vacancies on the one chart that John showed us, and it continues to be a very strong asset group across the country. Office, that gets significantly trickier. Lenders are very cautious. They like to see some government leases. They're looking for credit leases. They're looking at tenants that are primary drivers in the market itself. And they like medical office. If there's a good reason to be there, obviously research, again, comes up when you look at this, but lease term is also going to be important, so keep that in mind. But that is certainly going to be one where you hear the word recourse thrown around a lot. So keep that in mind. Retail is probably the second most desired property type in these smaller markets. Anchored retail is definitely desired. Unanchored retail continues to be difficult. That hasn't changed significantly. Credit tenants are always desired, along with the anchored retail. So again, keep that in mind if you're looking at those asset types for acquisition. Industrial probably falls a close second to retail, and kind of the same rules apply there. Lenders are looking for tenants that are market drivers in the local economy, and that's really what's going to take the day. As far as other type of assets, special purpose is effectively a no-go in small markets. And unless there's an incredibly good reason, like a very long credit lease, they really get tricky and difficult. With that, who's in these markets? Who's actually lending? I touched on it a little bit, as I said, with the multifamily. You got Freddie Mac, Fannie Mae, HUD in these smaller markets, and the small life companies, securitized lenders, but really there's a couple of opportunities out there. We've got some small banks that we've been able to get 10-year loans from in some of these really small markets, and it's kind of been a game changer on a few deals where they kind of stepped up to the plate and threw terms out there that we weren't really expecting, that were actually very competitive and very good. And another area where we've had a really huge amount of success with are these co-ops of small banks and credit unions. These are not the easiest people to find from a financing standpoint, but it's probably one of the best kept secrets out there. We've actually had these groups step up when the other groups that I mentioned above had turned deals down. So again, there are different types of financing out there, and again, we have found some of these smaller co-ops, banks, and credit unions to step up and be fairly significant players in these deals. It's still a fickle market, and that especially goes for securitized lenders because everything is driven based on the actual markets themselves and not necessarily the real estate market. So you need to keep that in mind. And what I'm going to talk about on this next slide is really kind of what the underwriting looks like on these respective property types. I think there's a couple things you need to think about. If you're buying in secondary and tertiary markets, you need to be flexible. You need to understand where the underwriting is going to be. Don't use parameters that are used in primary markets because if your equity requirements are going to change, and you'll just be wasting your time. And second thing is usually the sweet spot's anywhere from 1 to 20 million in these markets. The lenders, for the most part, don't like a lot of real estate risk, so they're going to look real closely at the rent rolls. Interest rates are going to vary probably by 100 basis points up to 100 years into a credit component and going out of the deal. They look, of course, at rising interest rates. We're all enjoying these historically low as Albert mentioned, the HUD rates are, can be sub 3. You look at in Freddie and Fannie between 3 and 4. But there's a lot of lenders are stepping up and starting to have these tougher refinance tests, especially in these markets. And again, I don't want to around in the smaller markets. We approach every deal here.
Ernie, we're running out of time a little, so if you want to wrap it up.
Okay, so basically with the recourse issue, basically what it boils down to is every deal we send out, we go out with the mindset that it's non-recourse, but you need to keep that in mind. A multifamily, real quickly, it's not dramatically different in the underwriting. You get 65 to 70% LTV, 130 debt service coverage is pretty much the minimum. Amortization up to 30 years is not unusual. Office is 50 to 60% LTV, 150 debt service coverage. Tenants need to really be strong and drivers of the economy, and amortization tough. Same with retail. Actually, what we see with retail, probably the one point to make there is amortization typically is 5 to 7 years past the anchor lease, and you need to keep that in mind because that can sometimes really shorten a deal. Industrial, very much the same way, and that's really the end of how of what I have here, other than a little more detail that we really don't have time for. So, Keith, I'm going to kick it right back to you.
Okay, great. Well, thank you so much, Ernie, for an insight look into how the lender thinks, and thanks for your great tips. We have a lot of questions that came in. One question is, maybe I can throw this out to the panel. Do you have any thoughts on how secondary and tertiary markets are defined in terms of population numbers, or do you have any thoughts on that?
This is John Sebree. I will answer that a little bit. The answer is that it's very subjective, and if you put 10 people in a room and asked them all the same question, they would all end up with different markets. I think generally you're going to have San Francisco, New York, D.C., Seattle, Los Angeles are always going to end up as the primary markets. The question is then at what point do you adjust that into a secondary market and into a tertiary market? And the answer is there is no hard and fast rule. And generally you're going to look at different services that are providing research and that are doing in-depth research, and they're going to categorize it a little bit differently. So I know that's not a hard and fast answer, but it is very, very subjective.
Okay, great. Thank you. We have quite a number of, we're sort of running out of time. Let me just mention that we've had a lot of questions regarding whether this is recorded. Yes, it's being recorded, and it will be made available on the websites of Multi-Housing News and Commercial Property Executive in about a week. If you click on the webinar tab on the left-hand side of either website, you'll be able to access a recording of this webinar. Let me see if I have time for just one question for Albert Berriz. There's a question for Albert Berriz. How do you go about identifying the specific properties McKinley's wish list in these markets? Are these properties typically on or off market? If off market, what steps are taken to get a proposal in front of the current owners? What would lead you to believe a secondary market is ready for spec development? Albert, do you want to comment on that?
Sounds like we need another hour for just for the answer to that question.
Seems like a great question.
It's just hard work. I mean, I think you're looking for deals on quote unquote on market and deals that are off market. The off market deals and the on market deals, you're competing with the general marketplace. So I think again, it's my presentation of earlier, 100 deals to do one. It's a lot more work than it used to be for us.
Great. Okay, I think we've run out of time. Again, this webcast being recorded, and recording will be available on our websites in a week's time. The websites of Commercial Property Executive, Multi-Housing News. We'd like to thank our panel of speakers for being so forthcoming. Ernie Katai, Albert Berriz, John Sebree, and Gary Ralston for their great presentations. And thank you to all of you for joining us. This concludes our webcast.